Daniel, thank you for taking the time today to be on the Silicon Valley podcast. Now, I'm super excited for you to be here because, well, it turns out we know all the same people. And in fact, I'm actually very amazed that we haven't crossed paths earlier, considering literally for everyone at home. I mean, we've had past guests that we're both connected with. Tonight's event later on that we're recording, I'd say 80% of the audience are mutual friends. So I'm pretty excited for this. And I know our audience is going to love this interview based on your background, what you're working on right now. So let's just get right into it. Daniel, can you tell our audience a little bit about your career up until this point?
Sure. Sean, thanks for having me. And that is hilarious to me, actually. I think we discovered a new mutual friend probably once every week on average over the last few months. Very funny coincidence. But yeah, happy to kind of go into how I got to where I am today. And honestly, that story is a lot deeper, I think, than just the career story. Honestly, I think it started really with my parents being immigrants from Poland. They actually left Poland in the 80s as refugees when Poland was under a communist regime. And they came and settled in San Francisco. So it was the traditional kind of immigrant story where, I had kind of three different career paths to choose because education and money is imperative for immigrant families, generally speaking. So I could have either became a doctor, a lawyer, or go into finance at the time. Today, if you had the same experience, tech would be on that list, right? So I hate blood. I can't memorize things, but I had a natural knack for money. So naturally, everything kind of in my early life predicated going into something financial related or entrepreneurial. I actually started my first business when I was 8 years old, selling candy. I upgraded to selling bootleg CDs when I was early teen, and I was making so much money. My parents thought I was dealing drugs, so I was definitely an entrepreneur through and through, and I kind of followed that path through college and ended up starting my career in the hedge fund world, really for a brief time. But the entrepreneurial life sucked me in very quickly, as I kind of expected. I probably left the professional world to be an entrepreneur a little too early. Life would have been a whole lot easier if I stayed a few more years and made some money and had some savings. But I gave up all of that to sleep on friends' couches and try to build things that people like to use. So my first kind of entrepreneurial experience was a company I entered as a fourth co-founder and kind of a product guy with a few design skills and a few business skills. And that didn't work out. We were just too early at the time and a little bit undercapitalized. And then I kind of just kept doing that for about a decade, really, almost a decade. And I think a more interesting part of that story is how I was able to survive for that long. Because as an entrepreneur, you don't get paid, right? Generally speaking, at least the first couple of years until you raise capital, and even if you raise capital, you're still heavily underpaid. So the way I got by is I actually took a lot from what I learned in the financial world, and I built algorithmic trading models, and I started trading derivatives, and that actually paid the bills. So I kind of fast forward to 2016. I founded my first breakout company. Every entrepreneur finally has that one that just works. It was a passion project to start. I'm a big cyclist, motorcyclist, electric skateboards, you name it. A little bit of an adrenaline junkie in that way. But I've had a lot of bikes stolen as well. And that's growing up in San Francisco. It's a rite of passage, right? So
I had 2 bikes stolen in about 6 months there.
Wow.
Yeah. Never go to the public library. Never go there.
Yeah. That's even worse than me, I think. Wow, 2 in 6 months. It's gotten worse, apparently. I'll need to get you a Skunklock, but
there you go.
But but yeah, that was my first company. Basically, the way I started it was there was a lunch conversation inspired by a friend that had his bike stolen, and he was using kind of the best lock he can buy at the time, and it happened in broad daylight. And people took videos and pictures of the theft happening. They cut through with the angle grinder and took it to the police, and nobody did anything about it. And it was a very expensive electric bike. So it was almost a gut reaction. It's like, why didn't the lock do something? And then finally ended up coming up with the Skunklock, which is kind of on the edge of legality. We just figured out just barely what can we do to dissuade theft. That's not just building a bigger and stronger lock that is still legal. And basically we have these food grade chemicals under pressure inside the lock. And if you cut through it with the angle grinder, they come out under pressure, and it stops the thief in his tracks. So that was kind of an accidental success in many ways. But I was very fortunate to have that as a breakout company. And really, that's when I guess people started in the business or in the community started taking me seriously as an entrepreneur. So I started getting other opportunities from there. I built a strong investor network. Actually, joined as a managing partner of an investor relations firm called American Pillar Partners. So, I realized I'm very good at that process of helping companies raise capital and be attractive to investors. So I realized that's one way I can make money while pursuing these companies that I want to start as well. And then fast forward again to April of 2020. At that point, keep in mind, when I built all these algorithms and was actively trading derivatives on the market just to pay the bills, I also made some of the code and some of the signals available to family, friends, and so on, and that were just following it for free on a rules basis. And I got a few phone calls in April of 2020, and essentially they were saying, I don't know what kind of magic you're doing, but we didn't lose any money, or we outperformed every other strategy that we're doing. And many of these people were paying professional money managers a lot of money to manage their capital. So they said, you need to create this into a company, into an app. And that's basically what we did. And then that brings us here, where I have too many children to manage. You know, one's an infant, one's a toddler, and another one's a teenager, I guess you could say.
Well, let's go back to maybe that teenager. I'm guessing Skunklock is a
Right.
teenager. Why? You mentioned that. Well, it's just kind of luck, but it couldn't have been. You had too many failures going up to there, where there had to have been lessons you learned. What were some of the lessons that you learned going into it that made it a success?
Funny story. As soon as we kind of came up with this idea, my co-founder and I, first thing I did was I actually, at the time, I had an electric skateboard. I went down the Embarcadero and I started asking cyclists, "Hey, I'm selling these locks for $100. Basically, if a thief cuts it, it'll explode with pepper spray." That's what I was telling these people. And I asked maybe 9 or 10 cyclists just along the Embarcadero. I spent a few hours doing that. Half of them started taking money out of their wallet. So that was kind of my crude way of validating the idea of whether it's just conceptually even viable. At that point, I had no idea if it would be legal. I had no idea if, from an engineering perspective, it was possible to even build it. But along the way, we did learn a lot of lessons in that company, and a lot of it comes down to, I think, how you get customer feedback. I think the biggest mistake I see a lot of startups making today is there's infinite numbers of tools where you can send out surveys to thousands of different potential customers in your target market. And yeah, so you can send out an infinite amount of these customer surveys, and that's what a lot of startups do. That's how they approach their customer development. They'll ask them a number of questions related to what kind of product that they want to see. And the problem with that approach is if I had instead given a survey to all these cyclists that I asked, they would have told me, yeah, we want bike locks that are stronger metal. And we want bike locks that have, disc cylinder locks that are much harder to pick. And you need special tools and so on and so forth. And none of those attributes would have solved the core problem, which they really had. If you kept asking questions, if you asked 100 questions and just told me, but really, what do you want? If you kept asking, they would have said, I want my bike to stop getting stolen once a year. And that's why I think it's a big kind of fallacy in a lot of the mainstream customer development processes. I don't think customers know exactly what they want. You have to show them a real solution. And that's the only way you're going to be able to understand that. And an example more relevant to the Sidepocket on the financial front, this is also relevant to investing apps as well. I see a lot of different investment apps email me these surveys of what do you want to see in an investing app, and what most kind of investors or new investors are going to respond is they're going to say, so I want better information on which stocks to pick, and so on. But the truth is, even with that information, most people don't have the time to trade actively, and they figure it out very quickly. They don't necessarily want to wake up at early in the morning and research and so on. But that's as a result of this process of sending out these customer surveys with set questions. That's the kind of responses that you're going to get that really aren't very effective at driving product innovation.
That's fascinating that a key to success is getting the market feedback, but it's got to be the right feedback and knowing what questions, I guess, to ask and who to ask. I mean, your current company, you had the product, you were testing it in a way, and then you got market feedback of, we want more of this. And your bike lock, I mean, that's just genius, going to the final customer and actually seeing them take out money. You kind of know you have your pre-orders there.
Right. Yeah.
So your last company, though, the successful company, it was a physical product, whereas your current company, it's a software. How is it different building a software company versus a physical product company?
That's a great question. As they say, hardware is hard. So there's a lot of challenges with building hardware that doesn't exist in software, namely building a supply chain that is consistent and down to getting physical materials. One, I guess, benefit of hardware products is that it's acceptable to raise capital to build physical products through crowdfunding, like Indiegogo, Kickstarter, and so on. We did an Indiegogo campaign, of course, so that kind of prolonged how long we needed, or how soon we needed to take outside investment. But in general, I would say software companies are much easier because there's also a lot more talent to hire in terms of building the product. They're a lot more scalable. It's a game of figuring out the right business model that's applicable to your company.
Interesting. And now let's move to the current company. It's in the fintech space. A lot's happened in the last few years in that space. And I mean, to be honest, unless you're in there, you probably don't really know what's going on. Can you update us on kind of what's happened, in this arena?
Yeah, the fintech space has grown exponentially, especially if you include all the different kind of sub industries there, in banking and wealth tech and so on. I think the most public kind of growth is really that of commission-free trading apps. A lot of it was catalyzed by the pandemic, and everyone has tried trading for the first time, pretty much. I think these apps have seen more than 10 million new downloads over the last 2 years. And that's unprecedented growth. And I think I'm actually very thankful personally for these apps, although I don't necessarily think they're the best solution for most people, and most people do figure that out in the long term. I'm thankful because now there's millions more people that realize the value of investing, and investing is not just something that some people do to put their savings in. It's going to become a necessity considering the macroeconomic environment and inflation, and who knows if Social Security is going to be around in 50 years, right? Yeah. So these commission-free trading apps essentially it's not even a competition in terms of who's getting the downloads. They're getting the vast majority of downloads on the App Store and Marketplace and so on. So what we've actually found, especially from our beta users, is many of them did try trading first. So they download one of these trading apps because it was commission free. So they don't necessarily understand in the background how brokerage apps make money, with payment for order flow, margin lending, securities lending, and so forth. So it seemed like a risk-free way to get into investing. Most of them said within 6 months they quit because they just didn't have the time, or they were losing money. So it wasn't a great fit for them, and many of them actually told us they're looking for, in their words, an easy button. So the traditional robo-advisors that are just, you answer a quick risk questionnaire essentially, and then they spit out strategic asset allocation, what they call it, of stocks and bonds. That was a little bit too boring for them. So traditionally, you go to a investment advisor, or traditional robo-advisor. Basically, they ask you a bunch of questions. They try to understand your risk tolerance. They spit out this allocation for you, and that's about it. If the market drops 50% the next day, they basically tell you, well, sorry, wait it out, right? And as it turns out, for most people, that's not good enough, and that's why they actually were shying away from investing for such a long time. So we're hoping to kind of be the solution that bridges that gap. So we're not necessarily a trading app. We have full automation, and you have access to these systematic strategies. So it's in some ways self-directed, because you get to choose which strategies, quantitative systematic strategies that you invest in, but you don't have to do the trading yourself. So we found that's very attractive to a lot of the people that came from these commission-free trading apps.
And we're not going to go into detail about actual trading recommendation because we want to avoid FINRA and the SEC here, but got a lot of questions for you on your company. One of the first things is, a lot of researchers will say timing is the most important key to judge if a company will be successful. Why would you say right now timing is on your side?
Yeah, that's a really important point. I think timing is absolutely imperative to the success of a company. And one thing that I will say, however, is the roots of this new company did not start in 2020. These are algorithms that I've been working on since leaving the financial world officially many years ago. It's been at least 7 years. So I really built them to solve my own cash flow problem when I was an entrepreneur, before I was selling locks. So I guess you could say I had a very unconventional career. But now, as you might expect, a lot of consumer level technology is really driven by innovation in infrastructure. So a good example is really the reason why Robinhood is successful is because they had a partnership with Apex Clearing. That was their clearing custodian. And they actually allowed them to offer fractional shares to their clients. And without that capability early, before they were doing self-clearing, they would have never been able to accomplish what they did. It wasn't just about being commission free. It was about being able to attract a small investor with as little as $100. And in our case, it's similar in a way. Many of these strategies that we're using that are primarily driven by either trend following or mean reversion, um, and broadly speaking, tactical asset allocation, which is kind of the other side of strategic asset allocation. It's really driven by underlying technology and partnerships that we were able to make with great clearing and custody partners and so on. So we're in some ways doing the same thing, where we're offering these strategies that previously we're not necessarily reinventing the wheel with the strategies that we are offering, or I should say we actually call them side pockets. So side pocket is a combination of different strategies, and the reason we do that is not all strategies perform well in every single different kind of economic regime or environment. And in the last 10 years or so, everybody's been a genius because we've been in a relatively low interest rate bull market with relatively low volatility historically. So essentially what we're offering is similarly to how these commission-free trading apps, we're offering fractional shares, and you can get into the market and buy a fraction of a stock. We're offering these quantitative systematic strategies that an investor can fund with as little as $100 or $500. And previously that was not really available in the market. You could only find that in hedge funds or with professional money managers. And generally speaking, the minimum ticket size was $1 million.
Daniel, I got to ask, right now, with all the government regulations and everything there, what's hindering the progress in this area? Is there any changes that you'd like to see being made?
I'm actually relatively pro-regulation. I think we've seen consumers be very vulnerable and really get taken advantage of in recent years by these commission-free trading apps, largely. When, for example, Robinhood launched, it took a very long time for people to start asking questions because they were so excited. Wow, commission-free. And originally they're advertising basically free, and then they had to add the commission part in front of that. But it took a few years for people to start asking questions and saying, hey, so if it's free, how do these guys make money, right? So that's when it became very controversial, and that's when I started getting questions from friends that were using Robinhood in probably 2018, around there. And that's when I had to explain to them that these brokerages, whether app-based or not, the majority of their income is not coming from commissions. It's coming from payment for order flow and securities lending, margin lending, and whatnot. So this is kind of a marketing gimmick that has just really worked well for them. They actually got fined, I believe it was $65 million by the SEC for essentially not really disclosing how they made the majority of their money. And I think that was a record. So in many ways, I do believe that investors need to be protected from companies because most companies in the space are not client first. So you have to kind of consider the difference between a fiduciary and non-fiduciary. Broker-dealer apps like Robinhood and Webull and even TD Ameritrade, they're non-fiduciary. So that means they do not have a legal requirement to do what's in your best interest. RIAs, or registered investment advisors, that can be mobile based. They can be robo-advisors, but they don't have to be. Do have a fiduciary requirement where they have to do what's in your best interest as an investor. And then within that, there's a lot of different kind of rules and regulations that are in place to protect investors. I don't necessarily think that there's any regulations within that have prevented us from being able to innovate in the space at this point. So I'm actually interested to see how that's going to evolve over time. I know there is uh, a lot of different literature that's more recently come out on this. I think one of the books or papers I was reading recently was called "Regulating Robo-Advice Across the Financial Services Industry," and that's a great kind of summation of what's going on from a legal perspective.
How has Merrill Lynch, Charles Schwab, and all these kind of, I almost want to say legacy um, brokers, how have they not been completely disrupted by Robinhood and Webull and these free apps or free trading apps?
They actually have. They as soon as especially the robo advisor apps, as soon as they launch, so the ones that are probably the most prominent now are Betterment and Wealthfront. As soon as they started tapping into that market, the big players, the Vanguards, the Schwabs, the Merrill Lynches had to build something comparable. Luckily, what all these robo advisors do is exactly the same thing. They all do essentially kind of modern portfolio theory as a foundation, mean variance optimization portfolios. That's very cookie cutter for the most part. So the largest robo advisor in the world is actually Vanguard now by assets, and a lot of people don't know that. And Schwab, I believe, is the second. And the reason for that is because they had such a large existing client base that all they have to do is offer this additional robo offering that honestly you could probably do yourself in Excel and pay a lot less fees with a simple YouTube video. I don't think most people understand how simple what this process really is that these traditional robo advisors apply. But that's what I normally recommend most of my friends do. But in terms of disruption, they were disrupted and they adapted, and now they're actually the biggest players in the industry.
What about the gamification? I mean, that's something that you hear in the news, how these apps are so addictive for millennials and people at home that maybe lost their jobs and they're just using it as almost, like casinos, almost like it's Vegas. What about the gamification part of these apps?
I think the gamification was one of the primary drivers of these tens of millions of new investors that became investors in the last 2 years. It was probably driven mostly by Reddit and what happened with GameStop and AMC, where essentially people were coming together to fight the hedge funds and Wall Street and squeeze the shorts, as they say. And it was just very exciting for people hearing about 1,000% return as a possible, or 10,000%. It all of a sudden it became potentially real impact on people's lives. So most advisors, you sit down with them and they show you a potential growth chart where you're returning 7% a year. And most people, if they start with $1,000, they see that they just made $70 that year. They'd rather go take that and spend it on a nice restaurant once a year. It doesn't seem worthwhile to them. So this gamification definitely was a big attribute there. Unfortunately, it is not very good for clients. Evidence from Robinhood users, and it was written by, I believe, 4 professors, and they examined kind of the impact of gamification on returns, and especially for new investors and less sophisticated investors.
Wait, but Daniel, with all these apps, gamification, these brand new apps coming in the market, how is what you're doing, how has it not already been done? How is it cutting edge? What are you doing that hasn't been tried before, and why hasn't it been tried?
I think that's a fairly difficult question to answer. It's kind of like, why hasn't anybody invented a bicycle lock that shoots noxious chemicals when a thief cuts it, right? I think you have to be aware of what inputs that you're looking at in order to really innovate in a space. So I think to a degree, one large differentiation is, yes, legally we are a fiduciary, and we fall into the robo advisor industry within wealth tech, which is within fintech. However, from a product perspective, we're really quantitative investment marketplace. So one way of thinking about it is where if you join Wealthfront or Betterment, you answer a bunch of questions in a risk questionnaire. They understand your risk tolerance and they spit out an allocation for you. That would be, if you did that, that would be a single side pocket on our platform that may be within the growth category. And it may have a recommended holding period of 7+ years and a risk of certain volatility and certain drawdown and whatnot. But we also offer dozens of other strategies that do very well in other kinds of markets, including trend following strategies, mean reversion strategies, and so on. But I think the truth is the reason this hasn't really been done is for people like myself and our team, and we're a bunch of kind of entrepreneurial spirits and hedge fund guys and overall growth hackers and whatnot. We would make a lot more money in the short term if we just started a hedge fund. And I think most people that have expertise in the space, that's what they do. They start a hedge fund. And in the short term, they make good money, they acquire assets and whatnot. I think fundamentally, the entrepreneur in me doesn't care about the short term as much as I care about long-term impact and doing something positive. So that's why we kind of took this on. We do realize it's going to be a long journey ahead of us. It will require kind of a paradigm shift in thinking for a lot of investors, and probably a decent amount of learning about the implications of investing in different kinds of strategies and strategy diversification and so on. But I think that's really the simplest answer, is in the short term, financially, most people would take the hedge fund route.
And then I have to ask, you'd mentioned quantitative before. What's a quantitative portfolio? And then I also want to ask, I got to hear a story or two of your company right now, of your journey, if you can share it.
Sure. So quantitative portfolios is quite simply a systematic trading and rebalancing strategy that essentially removes the human interaction from the process. So as it turns out, humans are pretty bad at a lot of things, especially trading and especially applying systematic strategy to trading. It's very difficult as a trader to see a position drop 20% and follow the rules that you have set out for yourself. So that's pretty that's a simple explanation of it. In terms of stories in the company, truthfully, I think we try to be as boring as possible. You're highly regulated in this business, and we try not to do anything too crazy. I think it's crazy already just taking on such a large industry that's well established. But I think anything very important is worth pursuing regardless of outcome. I think the biggest bubble right now is not in crypto. It's not in SPACs. It's really in this existing investment methodology, this mean variance optimization, and mostly executed with these exchange traded funds that follow different indexes. I think that is probably more of a risk to the portfolios of people in the future than anything else, because most people are essentially diversified for just one kind of economic regime. So we don't know if we're going to continue to have low interest rates in the bull market. So right now, everybody's kind of a genius. So I'm sorry I don't have super exciting story. I guess the most exciting story is about our latest business expense on how we acquire investors in the company, at least not for assets under management. The pandemic was a very interesting time to pitch investors, and it was very difficult to get a meeting. So I actually bought a 3-wheel motorcycle that's top down, so it's extremely COVID friendly. It's called a slingshot, and on occasion we'll take potential investors out to lunch in it and have a great time, and hopefully they see the vision and join us in the pursuit. But that's the most excitement I think I've had in the last couple months.
Well, I can't wait to ride shotgun, I guess, in the slingshot. But we got a little bit of time left. I got to ask, where do you see your company in the next 5 years? Where do you see the industry in the next 5 years? Or is 5 years so far ahead that it's more just to think the next 6 months, or what's on the horizon?
The interest in investing that was spurred mostly by the pandemic and people getting free money and GME and AMC and gamification, all these things have created unstoppable catalysts for people. I think people want to learn what the best methodologies are for investing. I think 5 years ago, or even less than that, people didn't really question the strategies. It was always save a certain amount of money, invest into a diversified set of ETFs, which, as it turns out, isn't really diversified because correlations approach 1 during a black swan event, and so on. But I think we're going to see a lot more tools and sophisticated investing strategies available to retail investors. Because the hurdle of teaching investors the implications of those strategies is going to become smaller and smaller. I think people have a lot of incentive now to learn in more detail how certain strategies operate and what kind of macroeconomic environments that they do well, and how they should be investing their capital.
Fantastic. And if anyone wants to find out more information about you, your company, what you're working on, what's the best way to go about doing it?
So our website is www.sidepocket.com. And we have pretty much everything on the homepage there. We try to make it as simple to understand as possible for the 3 different kinds of, client personas you can call that we've identified. The first big one is, we call them the FOMO feelers. And these are the people that are currently using traditional robo-advisors, and they're getting, sub market returns where they're seeing their friends just buy and make 100% a year. And then there's the second client persona is what we call the gamblers, or essentially the gamblers. These are the people that just downloaded Robinhood to try it out and end up losing a lot of money trying to day trade and realizing, hey, trading actively is not for me. I don't have the time or expertise. And then the third one is really the skeptics that really surprised us. These were the people that they don't really have interest in learning how to trade, and they were definitely looking for automation solutions. But more importantly, they didn't think traditional passive investing was worthwhile. 10% a year wasn't a meaningful amount to them. So really interesting learning about these 3 kind of clients that we've identified.
Fantastic. So just want to let all our listeners know there was no financial advice given on this program. There's going to be that little disclaimer in the show notes saying that, none of this was financial advice, just, cover ourselves. But Daniel, I got to say, this has been great. I learned a lot, and I look forward on having you on our show in the future. I wish you and your company the greatest of success. And, considering we all know the same people, I mean, a big win for you, I guess, is a big win for the whole network here. So, yep.
Thanks, John, for having me. Love talking about this kind of stuff.
Fantastic. And all our listeners, if you enjoyed this episode, please go on iTunes and other podcast platforms. Give us a good review Check us out on the SiliconValleyPodcast.com. And any of the companies out there, if you're looking for an investment banker to help you with mergers, acquisition, raising growth capital, and that is what I do outside of the podcast. So please check me out. You can go to my LinkedIn or my email. All that information's online. But for right now, Daniel, I want to thank you one more time for being here on the Silicon Valley Podcast.